You're listening to A Deeper Dive, a part of the Winsight Podcast Network.
Why are the public markets good for Cava Grill and not Panera Bread? Hello, this is Jonathan Mays, Editor-in-Chief of Restaurant Business. And in this week's episode of A Deeper Dive, I speak with Ron Shaich, the chairman of Cava and the founder and former chairman and CEO of Panera Bread. Ron just wrote a book about his experiences called Know What Matters, Lessons from a Lifetime of Transformations. And we ask him plenty about what's in that book. We talk a lot about the 1990s when Ron bought St. Louis Bread Company, developed its concept essence, and renamed it Panera. We also talk about the decision to sell Au Bon Pain, which Ron spent 20 years developing to throw his chips in with Panera Bread. But we also talk about activist investing and how one activist once told Ron that he knows more about Panera than Ron does. We also talk about why it's okay for Cava to go public, even after Ron himself hammered activist investors and the problems with being a publicly traded company. All that and more on this episode of A Deeper Dive. It's a fascinating conversation with one of the industry's more notable executives, so please have a listen. I am here with Ron Shaich. Ron, welcome to the podcast.
Hey, Jonathan, how are you?
I'm fantastic. What have you been up to, sir?
More of the same, I guess. I mean, it's been a overnight sensation in 4 decades.
All right. So I'm going to ask you the most important question of all first. Why change the name from St. Louis Bread Company to Panera?
Well, it was very simple. As we were starting to grow it nationally, we did the research, and it became clear that St. Louis was most represented by Anheuser-Busch beer and Clydesdale horses. And we decided that if we were going to take this national, we needed to infuse it with a personality that was more flexible and more malleable. So Panera, frankly, is a name we made up. There is no Joey Panera. I don't have a cousin. And the reality of it is it means bread basket. And it becomes the personality we can infuse.
Is it a blend of Spanish and Latin? Did I read that correctly?
I believe it is, yes.
Yeah. All right. Well, wasn't that a risk at that particular time? Because St. Louis Bread Company was obviously a regional chain at the time. People in St. Louis, I know people in St. Louis love that place.
Well, in fact, Jonathan, it's the exact opposite of a risk. We did the thing to protect customers. We maintained the name St. Louis Bread Company in the metropolitan St. Louis market and used the name Panera everywhere else. In fact, it was ironic. I used to have people write me and say, Ron, we were up in Chicago or we were down in Atlanta and I found a knockoff. This thing, Panera Bread, is knocking off your St. Louis Bread Company. And the reality is we renamed it Panera. We just protected it in St. Louis where it mattered to people.
But doesn't that generate some confusion?
I think everything's a trade-off. And I think it was far more important to respect the people of St. Louis by maintaining that name in St. Louis than the issues of dealing with duplicate cups or all those kinds of things that we operators think about. I mean, here's the bottom line. This was one of the most significant growth companies in St. Louis. St. Louis had tremendous pride in it. Why would we want to do anything but dignify and respect these most important supporters of the concept? So that was worth anything.
So, but at the time when you acquired St. Louis Bread Company, you already owned a relatively similar concept in Au Bon Pain. What did you see in St. Louis Bread Company that made you decide to buy another one?
Well, first, they were very different.
Yeah.
Au Bon Pain was at its best in urban marketplaces, and it really was croissant-focused. St. Louis Bread Company was entirely suburban, and it was focused around bread as its point of differentiation. And I can remember the first time I met Ken Rosenthal, who had been the original founder of St. Louis Bread Company. And he wanted advice on franchising. And I basically said to him, it wasn't something you probably wanted to do unless you were really ready for it. He invited me out to see his business, and I went out there with Mark Boyle and a couple of our people. And I was just struck by the number of people waiting in line to get into this establishment. You could feel it. And there was something very special. And the baked goods were special. The environment was special. And it was very clear to me this represented an opportunity for our public company, Au Bon Pain Co. Inc., to move into the suburbs to match our urban concept, Au Bon Pain.
Why couldn't Au Bon Pain work in the suburbs?
I think the nature of its croissant focus, the nature of its personality rooted in its French name, had less relevancy to what St. Louis Bread Company really could be and ultimately turned out to be when it took form as Panera. The truth is we bought St. Louis Bread Company, but by the time it became Panera, we changed everything from the design to the menu. We expanded it from essentially a lunch place in which the bread was the point of differentiation rooted in sandwiches. We grew a breakfast business, which took our volumes up from about 1 million to 1,250,000. We added a gathering place business, which took the volumes up to about 1,750,000. And by the time we rolled out Panera, which became the name, it was a wholly different concept.
Mm-hmm. So along those lines, I want to ask you about a quote in your book. Now, you just wrote a book, copies behind you, Know What Matters. And there's one quote in there that made me chuckle a little bit.
Chuckle?
And you were developing what you call your concept essence. And it was in this location in Illinois. And I believe you called it the Wheat Store.
Yes.
If you're one of these, why was it called the Wheat Store? I'm not entirely clear, but anyway, call it the Wheat Store. And when you walked in there at one point and you said, and I quote, "I found God." Could you explain that?
Yeah, I mean, it's a bit of an overstatement, but what I meant by that is I found everything I dreamed of for this concept. This was the embodiment of what we call concept essence. It's our vision for how we would compete. And when you're working on a concept, as I had for many years, and we had a vision for what we would do for the guest, you feel certain things and you want certain things for it. And I very purposely worked with the teams that were developing this, Scott Davis, Tony Coleman, working on the design. And I wanted to not visit it till it was done. And there was this just wonderful, overwhelming feeling when I walked in the door. This was that so much better than I ever could have imagined. And so for me, it was, again, a metaphor, an overstatement, but almost a religious experience. Wow, we really did this.
Mm-hmm. But that sort of leads me into, because we talked about Au Bon Pain and Panera and, the concept essence. And I don't probably need to tell you this, but, the bakery-café segment is Panera and then literally anybody else. And I
think I've owned half of that bakery-café segment at one point and probably looked at buying the other half.
Yeah. It was, if you could rattle off a list of companies that have tried to compete with Panera Bread, your corner bakeries, for instance, companies like that. Never. I mean, there is no Burger King to the McDonald's of the bakery-café segment. Not really. There's not even a Qdoba, if we're being honest with ourselves.
Yeah. So,
and what is it that about, because there was something that you did. I mean, when you walked into that Illinois location, the Wheat Store, what was it? Why does Panera Bread work? And nobody else has been able to even copy it. It doesn't make any sense to me. You should be able to mimic it.
Well, let's step backwards. All right. Let's start at a higher level. First, I think we came to an understanding of the bakery cafe niche with a view that winner takes all. We had to dominate that category. And so you can look around, you can look at every major category. You can look at McDonald's and Burger King. You can look at, as you mentioned, Chipotle and Qdoba. You can look at Panera and Corner Bakery. We needed to maintain that position of dominance because we had scale economics that nobody could compete with, and we could maintain that dominance as long as we maintained true relevance to the guest, as long as we were actually doing a better job. And so I would tell you that our focus in Panera was genuinely to really deliver on this vision of what was really the poster child for fast casual: real food, environments that engage people, people that cared, such that people felt better about themselves when they came through a Panera. They felt good about their choice. And when we first developed the ideology that became fast casual, it was clear to me after about 2 years of being out in the marketplace and studying it, is that 1 in 3 customers rejected fast food. They wanted something more. The key currencies of fast food were a lot of food for not a lot of money. What we were saying is, we're going to give you something that you feel better about, that you feel respected, that respects you, for just a little bit more money. And ultimately, that's at the core what fast casual is. It's real food that respects people.
Mm-hmm. Superb. So I want to talk a little bit about the mid-1990s, I believe 1996. And that had been a tough period for you, as you describe in your book. And amid this difficult period, one thing that listeners of this podcast appreciate is that Au Bon Pain, the challenges with that chain seem to be rooted in the simple idea of like flattening same-store sales, which seems to be ridiculous to me. Like that seemed to
and limited growth potential.
Yeah, limited growth potential.
It was at its best in high-density urban markets like New York, Boston, Washington. It didn't work in St. Louis. It didn't work in LA. And so we needed, as a public company, you need to feed the growth monster. And so ultimately, we started with Au Bon Pain, but we actually ultimately built an international division. We backward integrated into manufacturing. And then fourth, I bought St. Louis Bread Company, which later became Panera, as a gateway to the suburban marketplace. The key to, I think your listeners to appreciate, is if you're running a public company, your multiple, which defines your valuation, is driven by a future perception of growth. And we needed to deliver on that in a legitimate and real way.
But at the time, you made a massive bet, and I would still calculate it as a pretty significant risk at the time, because you decided to put all your chips in with Panera Bread, and essentially sell Au Bon Pain, a concept that you had worked for 20 years to develop and to do all of those things, and then suddenly it started to have some challenges, and suddenly, like, all right, so you packed up. Did you actually move to St. Louis?
I did.
Sold this brand that you spent 20 years on, and then started focusing on Panera. Tell me about that decision.
Yeah, so I think we got it slightly in reverse. Okay. So it wasn't so much the challenges in Au Bon Pain. Au Bon Pain had flattened in its growth, both comps and unit growth. But it was the opportunity or potential within Panera. You know, for every 1,000 people that talk about building a nationally dominant company, one ever makes it. Any of us that are in this industry knows how hard this is. And I've been through this process multiple times. And I can remember it was 98. And I was really kind of bumming. I was looking at this Panera that at that time had maybe 100 restaurants. And I could see it had power. And what did it have? It had consistent sales volumes at a fairly significantly high level, basically from Chicago to Portland, Maine. And it was very clear to me, this had the potential to be nationally dominant. But here was my fear, that as a division, one of 4 divisions in a public company, it wasn't going to get the capital. It wasn't going to get, most importantly, the human resources that are needed to make this happen. And everything is about paradigm, Jonathan. And I'm sitting on the beach talking to a friend, bumming about this. And my friend looks at me and says, Ron, why are you upset? I said, because we're going to destroy the most valuable asset we have, the potential of Panera Bread to be nationally dominant. My friend looked at me and said, Ron, what would you do if Panera was the name on the company and Panera owned Au Bon Pain, Au Bon Pain Manufacturing, and Au Bon Pain International? And I looked at this friend and I said, my God, if you know, I would monetize every one of those assets to protect the ability of Panera to become what it could be. I take that capital and I'd go down to St. Louis myself and I take the best people and I make it happen. That to me is the lowest risk, not the highest risk, because the risk we were in the middle of was risking blowing up the potential of Panera Bread. Now, I'm a kind of person, if I say I'm going to do something, I think about it a fair bit. And then if I really get to saying I'm going to go do it, I go do it. And that led to the worst year and a half of my life, Jonathan. As you said, Au Bon Pain was my first child, my first son. I loved that company. I loved the people in it. And there was blood on the floor. And change is really hard. And we didn't sell one business. We sold all of our businesses by Panera, 3 businesses. And that was the most painful year. And if you really want to look at it, any day during that time, you probably could have come into my office and convinced me not to, because I didn't want to, but I knew it was the right thing. And part of what I'm trying to say is you have to stay focused. Part of what we talk about in this book is how do you discover today what's going to matter tomorrow? You got to be focused on what's going to drive you to where you want to be 3 years from now and 5 and 7. And in retrospect, the decision to sell all those other divisions looks brilliant. I mean, I have people that come up to me all the time, right? And say to me, Ron, right? Why didn't you tell me the stock went up 100-fold from where it was in 1998, 1999? And I look at them and go, excuse me, you asshole. That's really what I want to say. I said, excuse me, you know, you could have bought my stock by the wheelbarrow load during those times. You chose not to because nobody could see it. Nobody wanted to believe it. And so the real bet, if you call it that, was not a bet. It was an understanding of the opportunity and a willingness to do what it took to make that opportunity come alive.
How were you able to convince people to go along with you? Because obviously, you know, you probably had to have a few difficult conversations on this one, did you not?
I almost didn't. The board wasn't necessarily in favor of it because the board had signed on for Au Bon Pain Co. Inc. That was the name of the company. St. Louis Bread Company, renamed Panera, was 100 stores in St. Louis. It was a division. And frankly, we had control of the board. And then my partner, Lou King, was very ill. And my dad had passed away from cancer. And we lost 2 of those board seats effectively. And frankly, the VCs that were in it, you know, they got into Au Bon Pain because it was hot. And that's what they knew. And so there was a big struggle. I can remember right around that time. I'll tell you 2 stories. I can remember one of my board members looking at me and telling me I was washed up. I should be on Internet 1.0. I didn't have it anymore. And I can tell you how, you know, we always talk about the great successes, but all of this has pain. And I want your listeners to hear it, right? With all that great success, there's trade-offs and there's personal pain and there's uncertainty. And I can remember along the way, I tell the story in the book about at some point I was so beaten up by it. I had one of my directors came to me and said, I'll buy from you the entire company. And we reached an agreement to sell it again for what would have been pennies on the dollar of what it ultimately sold for, just pennies. And I reached an agreement with him. And then he walked away from the agreement.
Wow.
Right. And probably the best gift he ever gave me. But at that moment, you're going through it. It's so hard. And the key, partially what I'm trying to say, is to stay focused on the long term, what you're going to respect.
Mm-hmm. So I want to make sure that I get to this question because it's an important one. Now, Panera, obviously, nobody at this particular point is going to argue with the decision that you made From a financial perspective, Panera was an amazing success, was ultimately sold for one of the highest valuations in restaurant industry history, no matter how.
It was the second. It was the biggest deal ever done in the United States restaurant industry up to that point, at among the highest multiples.
Yes, yeah. So by every measure, and then afterwards,
yeah,
you were.
And
rather.
By the way,
critical.
by the time we sold it, we'd run that company for 2 decades.
Sure.
Had 25% annualized returns over those 2 decades. Delivered twice the returns of Starbucks, 4 times the returns of Chipotle. And I was told recently that we beat Warren Buffett's Berkshire Hathaway. But frankly, that's not the part I'm most excited about. Like what I really talk about in the book is we transformed that company 4 times. Started as a croissant shop, we became a bakery cafe. We essentially came up with the ideology for fast casual and made Panera Bread the poster child. We made the kind of decisions we just talked about to sell everything and bet it all on Panera. And then I retired to do political work. And then I came back. Obviously, I failed at the political work. You can see the hyperpartisanship in the country. And I had the opportunity to come back. I had written a memo for how I would compete with Panera if I weren't part of Panera. And I basically called for digital and loyalty and omnichannel and clean food. This would have been around 2011. Mm-hmm. And my dear friend Bill Morton, who was our CEO at that time, looked at me and said, "Would you go work on it?" I came back to work on it. One thing led to another, and I'm working 80 hours a week on it. And I come back as co-CEO and then ultimately CEO. And all I did was put in place that very plan. And my point is, that's the part of it that I'm most proud of, mm-hmm. that we saw, we learned, and we transformed. And if this book is about anything, it's about how do you learn, and then how do you execute transformation with all the pressures coming against you.
Right.
Okay.
So then you sold it. So you sold it. And then afterwards, you were rather critical of public company, of activist investors in particular. And
public companies.
And public companies. And sort of the over focus on short-term investing, the presence of activist investors, which you had to deal with a couple of times. And now you've just taken Cava public. Why take Cava public? Why subject Cava to that? That's a nice guy.
Okay, so let's start. And I want to clarify, because I thought that
Sure.
piece you wrote, we need to align on or clarify. Right? Mm-hmm. And that is to say, look, I do argue for 90% of the CEOs that take a company public, they will live to regret it. Being public is a powerfully difficult position. You're increasing your constituencies. Those constituencies all have multiple and different agendas. So some of your constituents, your investors, are really worried about the next 2 weeks. What's your comp's going to be, so they can bet on the next inflection point. Others are with you for 5 to 7 years. You're far, it used to be when I first got into this business, the expression was long-term money was in the public markets. Today, long-term money is in the private markets. That's the reality. Having said that, for certain companies at certain points in their development, being public works. For me, it worked. It was an extraordinary, quite frankly, it worked out phenomenally well. Cava is set up and ready to be public. It's got an extraordinary CEO in Brett Schulman, a great CFO in Tricia Tolliver. It's got great management. Most importantly, it's in a powerful niche, Mediterranean. And we've known that. Our role in Act 3 is to look for those niches. I've been clear on that for 5 to 10 years. And this is the most powerful and dominant brand in that category. And this company has the potential to build out to 1,000 or 2,000 stores. It's right and ripe to be public. And this team is mature enough to know what it takes to run a public company. Plus, their investors, myself, the 2 lead investors at this point, Revolution, Swan and Legend, we're long-term, and we're with this company for long-term. So they have a lot of protection to make the right decisions for long-term investors. and clearly, unlike many public companies, are prepared to do what it takes to operate as a public company. This will be a good public company.
Did you do anything specifically to sort of protect Cava from some of the issues besides the fact that you're long-term investors and that sort of thing?
Well, I can say it this way. I mean, if you look at the prospectus, you'll see that we Invus and Act 3 alone vote nearly, I think it's 35-40% of the stock. Mm-hmm. We were very wise up front. I have longstanding relations with people like T. Rowe Price and Capri, the Americas funds. We brought T. Rowe Price in and we brought Cap in, both as cornerstone investors. When we did the IPO, we really made sure it was in the hands of long-term investors. This is a company built to deliver for long-term investors. And I think, we for example, we ran quarterly earnings reports and actually did a mock earnings release for 4 quarters before we went public, trying to prepare our team for what it is. And I can simply say that as much as any company, any team I've seen, this company's been prepared for, and this concept and management team is prepared for what it takes to run as a public company. Is it harder? Absolutely. Can it be a wonderful experience? Yes. I think Cava's benefited significantly from being public, if only from the credibility and the awareness in the marketplace that came from that public offering. So for Cava, it's a good decision. For most companies, it may very well not be, unless you're ready to be public, unless you have the kind of brand that can deliver over multiple years the kind of growth that the public market pays for. If you don't, you're going to get punished.
Mm-hmm. Mm-hmm. I want to bring up this quote from your book from Stanley Gold at a dinner you guys had.
My old friend Stanley Gold.
I did not know this story. I don't know if you told it before, but we know more about your business than you do. How did that make you feel?
Well, Stanley and I had an interesting dinner. I think it was Spago. So, he was the guy who took out Mike Eisner at Disney. And basically, he wanted me to put, he was the activist. They were attacking us. He wanted me to put his guy on our board and said, all you got to do is let him be your vice president strategy. I thought to myself, what does this 40-year-old, 35-year-old know anything about running a restaurant company? But we went out. I flew out there to have dinner with him. And we had many common friends actually in the community. And we had a really lovely dinner. And at the end of it, he says, he says to me, Ron, you're not really all that bad for a company we're attacking, And I look at him and go, for an activist, you're really not as big an asshole as I thought you were. I mean, listen, this is part of it, okay? And the point is, and I have been deeply opposed to the role of activism in our industry. It makes it so that you can't make long-term bets. And the greatest strength of Panera was we could make long-term bets. It was partially because I voted 17% of the stock. It was partially because I had this credibility. We had this performance. And our long-term investors, like T. Rowe, had stuck with us through both sets of activists. But most companies don't have that. And what pervades most boards is this short-termism that's powerful. And it happens. And when you do that, it takes away some of the most powerful ways to build competitive advantage, which is really how you create value in the end. And I guess I would say to you that activism, if you get yourself an activist, it's really, first off, you don't want to put yourself in that position. But if you do, you better make sure you have the people with you as you're going to go through it, because it's very hard to make the argument. Well, popping the stock is a bad thing. It's not very hard to come into a company, any company in our industry, and say, cut the G&A, take that cash, put another turn of debt on, take that cash and buy back stock, and you're going to see the stock price go up. I can do that anytime. And what ends up happening? Somebody gets left with the carcass. And if you care about the communities in which you operate, if you care about your people, if you care about your long-term shareholders, and you care about what that company could become, that's often to the detriment of the company. I'll tell you and your readers and your listeners something, Jonathan. When I first went public, the average shareholder held for 4 months. By the time I sold the company, the average shareholder was holding for 4 weeks. There's a pervasive short-termism. It's not actually good, but it's a reality. So you'll learn, like everything else, to deal with it. And I've helped any number of people, half a dozen people in our industry, some people you might know, who've had activist attacks. How do you think about it? What do you give to them? Because they have legitimate points of view. They're legitimate advocates in your organization. What do you give to them? Where don't you? What are you willing to fight on? What are you willing to say, I'm not going to do no matter what? And understanding that is really the power.
Now you're back. You're a concept investor. You're sort of back to where you love doing. Yeah.
Yeah. Well, I wouldn't say I'm an investor because we have large positions, and I'm really supporting teams with both my own team and the teams in place. So we're in 4 different. Our first bet is we're betting on the niches. And like we write in the book, how do you discover today what's going to matter tomorrow? I want niches that 5 years from now have a tailwind behind them. So what are we betting on? We're betting on Mediterranean. You know where that is. #1 diet in the country. It's powerful. It has the potential to be, in Cava, a nationally dominant company.
Yeah. We've been waiting, by the way, not to interrupt you, but we've been waiting for a Mediterranean concept to become national since I started covering this business.
Well, watch Cava. Here we go. We've got it, and they've got it, and they've got the momentum.
Okay.
Secondly, we're in. We have a company in Plant Forward called Life Alive. Powerful, strong volumes. We know 3 to 4% of America is eating vegetarian, but 40% want to eat Plant Forward. It's another niche, right? Nobody's ever cracked it. We think we have the potential to build a powerful, nationally dominant brand. Third, we're in upscale. Israeli, Lebanese, Turkish bakery-café. It's more cafe. It's got authority in coffee. It's got authority in third-wave baked good, and it's got chefs in every one of our establishment. It's again another powerful concept. We think it's got lots of potential. And then we're doing immersive entertainment. I've got something called Level 99, really interesting. It's 40,000 square feet. Old Sears. It's got these 40 challenges. It's got a farm to table restaurant. It's got a brewery in the middle of it. Really interesting. And then we have another practice we do with public companies where some of the institutional investors invite us in, or the companies, and we basically provide board level support and strategic advice. And we'll take somewhere between 2 and 10% of the company in warrants to help in that process. I will tell you that our operating principles are different than anybody else. We're not venture capitalists. We're not private equity. I have 25 people. All the money in Act 3, we put a $250 million in. It's now got a portfolio worth in excess of $1 billion, 45% annualized returns, and it's all our money, right? No LPs. And we have 2 principles: founder-friendly capital and what we call Sherpa management. Founder-friendly capital means we come in as common. When we come in, we will arrange to ensure that management team will never have to go for another financing. We basically take on a right to all follow-on rounds of capital at a pre-agreed to multiple. Capital raising should not be a life cycle event like a birthday. It's craziness. Go run your company, focus on being a better competitive alternative. We'll make sure you have the capital, and we've never turned it down. Secondly, we practice what we call Sherpa management. I would argue building a nationally dominant company is tougher than climbing Mount Everest. Nobody climbs Mount Everest without a Sherpa. Why are you building a national company without somebody who knows something and can help you? And so we're in the boardroom. We're not looking at the liquidity event. The next one, we've never sold anything of any substance. We're not looking at the liquidity event. What we're focused on is how to protect you and help you build a better organization and dominate your category or your niche. To that end, I've got partners that do strategy, I've got partners that do real estate. I've got partners that can get involved in operations if you need it. I've got other partners in food development. And one financial guy in the whole deal. One of the activists actually who attacked me, who I became friends with. I couldn't tell anybody at the time, but I actually grew to really respect him and like him. He joined us, and we keep him in control. He refers to himself now as a reformed activist. But my point is, we can help the organizations we invest in, and we can help them because we provide these services on a cost-plus basis, and they can pull them. And so you put this all together, and simply all we're doing is doing what we know how to do: help build these brands. And I would further add, we're not investing broadly. We're investing where we have the house of egg. If you're investing in this industry, and we've been in this industry, I've been in it for 40 years, my partners for decades. If you're investing in this industry, we have a real good sense of what the niches are, and we actually know how to build a dominant brand in it. And frankly, you want to know how to do it? Read the book. It's in it. I mean, this is the book I really wanted for my CEOs. It's the book I wanted for my kids. And I also wanted to talk about something else in this book. And I think unlike so many of this genre, I hope it did. I want to talk about what it's really like, the pain, the personal dilemmas, the challenges, the trade-offs, what this really means for each of us as people. And how do we do it? And how do we not just build companies of value, but companies that we value? How do we build lives that we value, lives that are meaningful and powerful?
Right. By the way, I think probably the track record for climbing Mount Everest, or the success rate of climbing Mount Everest, is far better than building a successful company. I don't think there's any question about that. Ron, this was fantastic. Really appreciate you joining me this week on the podcast.
Thank you, Jonathan, and the best to your listeners. And it is an amazing industry. Thank you.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Kimmy Spoons Kazmarek, artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. And you may subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.